Well, Happy New Year. We are into 2025, and you know what that means. It is time for our 2024 market recap. Today, we're going to talk about how the financial markets did in 2024. We're also going to look at one of the biggest topics of the year, which was AI in the financial markets, and we got more for you. Let's dive into it. So we are going to start out looking at how the financial markets did in 2024. And back in January of last year, we put up a chart that showed the price target for strategists on Wall Street for the S&P 500 for the end of 2024. They were looking in their crystal balls. And look, that is a tough gig. We don't do it because it's very hard to be right, but we can gain some knowledge from them. So we're going to start by throwing that up. And you see there in blue where I say the S&P 500 closed 2023 at 4763. The average forecast target was 4861. So most strategists thought that the market was going to be up slightly. That was the average, should I say. If you take a look across companies, though, over on the far left, JP Morgan projected that the S&P 500 would trade at 4,200. That is a pretty significant decline. Not far off that, Morgan Stanley, Wells Fargo, and you can look across the board. Now, over on the far right in blue, it says target 6,090. That's where the market was last week when we printed this. In real time, it's a little bit lower than that, a little bit under 6,000. But here's the main point here. Note that none of the strategists came anywhere close to nailing the target. And in fact, if you had listened to the big banks, the JP Morgans and the Wells Fargo and the Morgan Stanleys, and gotten very conservative, it cost you dearly this year because it has been a good year for the financial markets. Now, let's talk about how good it's been. So we're going to put up a chart here that has the S&P 500. You can see it is up 23% for the year, a very strong year. The Dow Jones Industrial Average up about 12%. The equal weighted S&P 500, so that is if you take all 500 stocks in the S&P 500 and have them equally weighted versus as they are now where Apple and Microsoft are 7-8% of the weighting each. You see that's up about 10.5%. Didn't do nearly as well as the S&P 500. But let's look at the next two categories. Emerging markets, that's China, India, Brazil, up 4%. And international markets, that's Japan and most of the European countries, flat for the year. Why this matters, here at our firm in 2024, we had no exposure to international. This is a big difference between us and a lot of the big banks who say, hey, you need to have 10, 20, 25% in international stocks. That has not worked now for almost 15 years. And once again this year, that investment did very, very poorly. But the S&P 500 did very well. And what really drove that was big tech, which was a very similar story in 2023. You had NVIDIA and Tesla and Amazon and Apple all up 50%, 100%, 150%. They did very well and they drove returns. If you look kind of outside of that, returns not quite as good. But in general, a strong year for the stock market. We were very glad to see that. So there wasn't a bigger buzzword this year than two letters, AI. It took the market by storm. It's all you could hear about if you turned on CNBC or Fox Business. And there's good reason for that. A lot of companies are spending, tens and $20 billion building up their AI capabilities. And so that impacted the stock market. And the poster child of this was NVIDIA, a company that makes the chips that are needed to power all the AI applications. And your Amazons and Google and Microsoft buying up chips as fast as they can. They're hard to come by. And I'm going to put up a chart of the price of NVIDIA. It went up over 160% in the first 6 months of this year. And I should add, this is after in 2023, 2023, NVIDIA was up over 200%. So it came out of the gates hot this year, running all the way up to $140 a share from just over 50 coming into the year. And it peaked originally in June. What you'll notice, though, is the back half of the year that NVIDIA's stock has, it's at the same place today that it was in mid-June is the best way to say it. It had some volatility along the way, but listen, this is one way when you have a stock or a part of the market that goes up a lot in a period of time, there's two reactions that can happen afterwards. One is the stock comes crashing back down, okay? You don't want to see that. The other way it can kind of soak up those gains is by going sideways over a longer period of time. That's what you want to see, and that's what happened to NVIDIA. The last 6 months, it's kind of handed the baton to some of the other tech names after it did a lot of the work in the first 6 months. Now, there were some other companies that where there was a lot of hype around AI, and at different parts of the year, these are companies that people would talk about a lot, saying, hey, you need to invest in these names because they are going to be the next big AI winners. And we have a chart here that lists 6 or 7 of them, and this is in the year 2024. And what this chart is showing is how far off their high are the companies. So when they're up at the 0 level, that means they're at a high for the year, okay? Why I want to point this out is you will see that in the last month and a half, a lot of these have gone down. And if you look at the names, ARM Holdings down 32% from their high. Supermicro down 74%. Supermicro at one point this year was up over 1,000%. It was in a clear bubble, and that bubble has burst. Some other names, Vertiv Holdings, Dell, Constellation Energy, which they are electricity, they're a utility, and there was a lot of excitement around them. That stock went up a lot, saying, hey, all of these AI applications, they need more electricity to run, and so you're going to need utilities, you're going to need power for that. Constellation went up a lot. And then MicroStrategy, I have them on here because they have a little bit of an AI component, but they also have a crypto component. That's something else I want to mention here. Bitcoin had a very good year, especially after the election. It went from 70,000 and change up over 100,000 to 108 at its peak. It's back now around 93,000. But this stock, MicroStrategy, a lot of people, it's a tech company, a software company that buys Bitcoin. It goes and issues debt and takes that money and then buys Bitcoin. It's become a kind of a religious fervor around this name. This stock is down 36%. Basically in just the last couple months. And because again, got to be too much excitement here in this part of the markets. So I want to highlight this because there are definitely going to be winners around AI in the years to come. But picking those winners now is very difficult. It's kind of similar to in the late 90s. If you had known that the internet was going to be what it has become. And there was a lot of excitement in the late 90s around the internet. But most of the companies that were thought to be the winners there went bankrupt, or the stocks went down 80, 90, 95% between 2000 and 2002. So most of the companies that were real winners in the internet didn't come public until 2003, 2005, 2007. It's similar with AI right now, is that there are a few winners like NVIDIA that already are seeing massive revenue because of it. But there's going to be a lot of companies that there's hype around that don't turn out to be the winners. And so you have to proceed with caution around this theme. Now, the next story that was in the headlines in 2024 was the government debt. And before I dive into this, it's important to note that for the last 10, 15 years, if you listen to, certain cable news or certain hosts, they would tell you that the end was near because of the amount of debt here in the US, that the markets were going to go off a cliff, that the dollar was going to crash, etc. That is not what we're saying here today, okay? But it has started to matter in the last year and a half in the markets by the fact that the federal government has spent so much money, more than what they've been bringing in, and it's had an impact on the markets, and it did this year. So we're going to start by putting up two quick charts back to back. The first is the amount of public debt that the government now has, and you can see that is at 35.5 trillion, and this is going to update in the next 2 weeks. We'll get the most updated number, and it's going to go over 36 trillion. This is very, very high. Let's not forget that it was just 25 years ago where we were sitting at about $6 trillion in debt. And since then, we have had 2 Democrat presidents and 2 Republican presidents. And between them, they have just sent spending to the moon. And we've gone into this kind of a debt. And because we have that much debt, the next chart is looking at how much interest in our federal budget is going to, how much of the budget is going to pay for interest on our debt. And notice this is now at $1.1 trillion, more than double what it was just 3 years ago. This is a big problem. If we didn't have this, this is, 500, 600 billion less that would be going to our deficits, or you could take this money and spend it on other areas, though I'm not a big fan of that, but if you were so inclined, you could do that. But this is an issue here. We are now at levels that are so high that it is starting to have an impact on the markets. One of the ways it does that is that the federal government this year spent $2 trillion over and beyond what they brought in, so we had to issue a lot more government bonds to fund that. Well, when investors know that the government has to issue all these bonds, they're saying, hey, we want a higher interest rate as a result of that. And that leads to our next chart, which this shows over the last 3 years, the federal funds rate and the interest rate on a 10-year Treasury bond. And that's where this really comes into play, all of our government debt. So let's start by looking at the blue line, because there's a lot going on in this chart. The blue line is the federal funds rate over on the far bottom left. It was at 0 following COVID, but in 2022, they started their rate hike cycle, took rates as high as a range of 5.25% to 5.5%. The 10-year Treasury yield in orange, you can see, has kind of danced around over time. In the last couple of years, it has been below the federal funds rate. And what I want to point out is in the last 3-4 months, you'll notice in blue there about 3 months ago, the Fed started cutting interest rates in September. But if you look the orange rate, when the Fed starts cutting rates, that starts going higher. And you may say, wait a minute, why are rates going higher on a 10-year Treasury loan if the Fed's cutting rates? And that's because 2 different dynamics here. The Fed's cutting rates on overnight loans that banks charge each other, or if they want to go lend to the Fed. But the orange rate is what consumers are demanding, the interest rate, if they're buying a 10-year government bond. And that has gone higher on a couple of reasons. One is a positive thing. The market has been pricing in higher economic growth in the years to come. And that's one of the reasons that went up. But one of the reasons it went up also is because there's so much government debt being sold week after week after week, and investors are saying, we want a higher rate. This is not good. Now, the line in the sand here for this line in orange is 5%. We got there briefly in October of 2023, and when we did, it put an absolute freeze on certain parts of the economy, and specifically housing. Why? Because mortgage rates are priced off the 10-year Treasury. So when that hit 5%, mortgage rates were over 8%. There was nothing happening in the real estate market. It was in an absolute freeze during that period of time. So right now, the 10-year Treasury rate's 4.5. We are going to be watching this carefully in the months to come. We do not want to see this go above 5. But the bottom line is, in 2025, it is going to be very critical that the government get their spending under control so they don't have to issue as much Treasury bonds. We're going to be watching that one carefully. So now we're going to do rapid fire through a variety of charts that are very important to kind of illustrate what took place for 2024. And we're going to start off by looking at something that is forward looking, but it's important now. And that is taking a look at where the market thinks the Fed funds rate will be at the end of 2025. Listen, at the start of this year, we talked about the fact the market was pricing in 6 rate cuts for 2024. We said in our Outlook video, we thought that was excessive. We thought 3 were more likely. And guess what? We nailed that one. The Fed cut rates 3 times. Well, right now, the market is pricing in for 2025 only 1 rate cut, okay? Or 1.5 rate cuts. So take a look at this chart. In black, that's the Fed funds rate. They have been cutting like we talked about these last 3 months, and that is sitting at 4.33 now. But in purple there, this goes back to August, and you can see in September, the market was saying that Feds were going to cut rates down to 2.5%. That's almost 8 rate cuts for 2025. But notice in purple, over the last couple months, this has been going higher, and now the market's pricing in just 1 or 1.5 rate cut. Look, we don't know what's going to happen, especially once you get into the back half of 2025. But right now, the market is saying, hey, the economy is growing, and we expect it's going to be really strong next year. The Fed's not going to have to cut rates to stimulate the economy, and the market also wants to kind of be on alert, make sure that inflation doesn't begin to become more of a problem next year. We'll talk about that a little more in our 2025 Outlook video next week. Okay, next topic, GDP growth. All right, so for the U.S. economy, this is another area where coming into 2024, a lot of economists who were sure we were going to have a recession in 23, which did not happen. In 2024, a lot of these people said, yeah, we are going to have a recession, but if we don't, growth is going to be pretty anemic. 0.5%, 1%. Well, that has not happened. And in fact, GDP growth is, for the fourth quarter right now, is projected to grow year over year at over 3%. If so, that will basically be the third quarter in the last 4 where growth has been over 3%. That is very, very strong. Any GDP growth over 2, good. Once you start talking about 3 or above, that is fantastic. Higher GDP growth has meant higher profits for companies this year, and that's one of the reasons that the stock market has done well. All right, next 2 charts. We're talking about the jobs market. As you know, if you've watched our videos, we follow the jobs market closely because that is what powers consumer spending. These last 2 years, one of the reasons we did not think that there would be a recession and why we thought the economy would do better than expected is because the jobs market was so strong. Well, guess what? It is still looking good. Our favorite chart, initial claims for unemployment insurance. We get this every week, and you can see that is at 219,000. It has been in this tight range now for 3 years. In other words, companies are not laying off employees. A few times this has gone up slightly to above 250,000 during the summer, and each time a few economists came out and said, wait, the jobs market's rolling over. This is not good. The economy's in trouble. But we did not go along with that. We thought, hey, that's temporary. It's going to come back down. And thankfully, that's what happened each time. But companies are not laying off workers. That's good news. Now, another chart on the jobs market I have is a good one. This looks at what % of workers are federal government employees, because a lot of times you hear a narrative that, hey, that the federal government is most of the jobs that are in the economy, especially these last couple of years that have been created. But take a look at this chart. This goes back to the 1940s, okay? Long, long time. And you will see now for the last 70, 80 years, this has consistently been going lower, meaning the amount of employees that are out there in the federal government are becoming a smaller and smaller amount of the total workforce. Now, this does not count state governments or local municipalities. It's just looking at the federal government. But you will notice that this is sitting at around 1.5% right now, which is where it has averaged over the last 20 years. Meaning a lot of the jobs market is still looking very strong, where private sector jobs are still most of the jobs that are out there. Okay, we're almost done. Hang in there. Two more charts to go. The next one here is taking a look. It's called the Red Book Index. It looks week over week at retail spending for consumers. And you will notice we just got, for the last week, a 7.1% year over year number here. That is very strong. It's the second best week of the entire year. And you may say, well, wait a minute, Will, it's the holidays, it's around Christmas, of course it's doing well. Yes, but that was the case last year at this time also. This is an apples to apples comparison. This number is very, very good. That means consumers are still out spending. And by the way, there are a lot of other indicators of this as well, not just Redbook, but I like Redbook because it's one of the most thorough. All right, that brings us to our last chart. So this is going to be taking a look at earnings per share, because listen, in the long run, there's nothing more important for the stock market than where company profits go. Because if profits go up over time, the stock market's going to go up also. If they drop, that's going to be bad news for the markets. We'll take a look here and you will see right now in I think purple here, middle of the page 24, the market, the S&P 500 companies are going to come in at about $243 per share of profits. For 2025, right now, that's projected to be up at $273. That is growth of about 12%. By the way, this year, 2024 growth was about 10%, double-digit earnings per share. That is very, very good news. And the key thing in this chart is actually the red line. That is taking a look at the upcoming 52 weeks projection for company earnings per share. And notice, since 2023 started, that has been steadily going higher. And guess what? It's not a surprise that in 2023 and 2024, the stock market did very well both years, and this was what drove a lot of that, companies making more profit. Now, one housekeeping note. Our last video 2 weeks ago, we talked about the fact the stock market was starting to show some signs of euphoria, a little too much excitement, and that a sell-off at some point would be a good thing, a healthy thing, and literally within 4 hours, a sell-off began over the last couple weeks. It has continued, and listen, this is perfectly normal. When you get a very good rally as the market had, it is not unusual to have a sell-off. And look, we view these as opportunities when we can start to go shopping at some values being created. So we wanted to highlight that. Now listen, it's the end now. 2024 is in the rearview mirror. We wanted to say thank you to our clients. It was a good year for client portfolios. It was a good year for growth for Sentara Capital, and we really couldn't do it without you. Thank you so much. And if you aren't a Sentara Capital client, we'd love to talk to you. You can go to sentaracapital.com. If you're not getting these kind of market updates, go to the website and reach out. Thanks for watching and take care.